There you go, Glenn. Now we got it. What is going on, Hot Take of the Day Nation? It is DRW here. We are recording an episode I'm actually excited about. Harris Kupperman and I met earlier this week through a joint contact who we had on the show as well, Josh Young, right?
Josh? Yeah, good friend of mine.
Yeah. Who, if you haven't listened to that episode, it's one of our top 3 episodes, and we cover a lot of really interesting things. Josh is a really smart guy, so when he introduced me to Harris, I was like, okay, I got to get someone else because I love these conversations. So, Harris, welcome to the show.
Hey, thanks for having me.
Yeah, why don't you give us a brief introduction as to who you are, what you do, and so listeners know what we're likely going to talk about.
Great. So I run a small hedge fund, long-short equity, mainly small cap, focused on finding sectors that are experiencing some sort of inflection. Get there early in the inflection, is ride it, and we ride it as long as we can. Sometimes that's a couple of weeks, sometimes that's a couple of years, but we're really focused on sectors undergoing dynamic change and some sort of inflection.
So and there's no limit at all to what segment of the economy you invest in, right?
Truly global. I mean, you've heard of global macro, right?
No.
So global macro is the guys trying to guess on interest rates and currencies and maybe gold. I like to say I focus on global micro because, I'm going to leave those really difficult ones to other people. I'm going to focus on the things that no one's really thinking about, no one's really paying attention to, where I have real competitive advantage.
Okay. So as you look at the world today, and we were talking just before we started recording around, how easy, it's amazing that you and I can be broadcasting effectively what is a television show in higher quality than many of the news media shows would have been broadcasting 15 years ago. And it's being done with a webcam, a microphone, a Zoom app for basically free, and from a content generation standpoint, we can create anything and everything. And so on the one hand, it's amazing that some of these media companies are so valuable, and then on the other hand, you think about a company like a Twitter or a Facebook who clearly have a lot of value, but that is where the entire world gets its news, interacts. That platform is the new media. How do you distill that macro trend from the micro and identify investing trends in there that make sense?
Well, the first step is you identify what's happening, which is what you just did. The days of the big monolithic media companies is over. They all consolidate each other and they produce terrible content because they have no competition really. So guys like you set out to build something different, and you're going to have a platform where you are going to post your content. That's going to be Twitter or Facebook or whatever that is. And that's the new world because you're producing content, and it's not mass market content. It's not meant for tens of millions of people, or maybe it is. But you're looking to produce something that's truly interested to a unique subset of people that want to learn something.
And so when you think about the state of the media, and I did a post on it earlier this week just around, it feels like whether it's from censorship or whether it's from narrative, notwithstanding the fact that maybe media companies shouldn't have as much control over the airspace, they seem to. And then with the Twitter hack yesterday and the Bitcoin and all that, we're in this really uncharted territory. And I'm curious, from your micro investing themes, what are the key themes that you're trying to pick up on and harness, and how do you see the role of social media and all of that?
Well, in terms of social media, I think there's a lot of really smart people following what's happening there. I'm not sure what my competitive advantage is going to be. I would say that I think Twitter is a very undervalued stock. I think Jack Dorsey's days are numbered. I wouldn't be surprised if the activists are the ones who hacked him. How else do you get rid of a CEO that's hard to get rid of?
Right.
Yeah. Well,
he wanted to.
Yeah, he wanted to move to Africa half the time, and COVID hits, and this was a huge hack. Truly unbelievable.
It's truly unbelievable, and when you look at the people who were smart enough to hack it, and all they wanted was Bitcoins, it just seems like the people who hacked it weren't really out there to make money. They were out there to prove another point. I don't know if it was political, or they're going to blackmail people in the future, or was to get rid of Dorsey, but it's something a lot bigger than collecting Bitcoins.
So we talked about on the phone, and we're going to touch obviously on oil and gas, but I want to have you talk about value investing versus growth, and not because the Tesla story is not overdone, but explain to people the Tesla phenomenon, which is a $350 billion market cap company, trades at 15 times revenue, is now like 50% bigger than Exxon, and growth versus value. I mean, if you wanted a poster of like growth versus value, I would suggest that Exxon versus Tesla is probably the two feature art in that. What say you?
Oh, I agree completely. I don't really understand why Tesla has any value. It has never had profits. It will never have profits. I mean, there's a reasonable case to be made that most of the financial statements are fake. Um, they created a car working with Daimler that was a very good car, the Model S. The Y is something of a mess. The 3 is worse. And the Y coming after is just a joke. I don't think they'll ever actually have another product afterwards. They spend no money on R&D. I don't really know what the focus of the company is at this point. It is kind of just to perpetuate the Ponzi scheme. And then, they're kind of running the business for next quarter to keep the balls in the air. I just don't get it. We can go deep down the rabbit hole of why Tesla's a fraud, but I don't think that's as interesting as, just why is this thing so overvalued, and why are companies with true cash flow? I mean, the point of investing is to buy cash flow. Why are some of these other ones being so undervalued? And, it's indicative of a massive bubble.
And so what is so interesting to me is everything you said, and notwithstanding the fact that everyone has, like, my favorite input or feedback on Tesla is, well, it's not a car company, David. It's an AI company that can't be replicated. And I'm like, well, I'm not, like, I mean, there's just it doesn't mean it's worth $350 billion. And so it is interesting that very smart people like yourself, who are long managers of massive amounts of pension money and trillions of dollars of true money, are buying it, staying long, and winning. They're up like 4x this year. And then the shorts, who like Herbalife, like some of these other famous stories, and Bill Ackman, like, they just get crushed. It's amazing to me that what seems to be an overinflated Ponzi scheme, where quite frankly the CEO, who I respect as a visionary and as an entrepreneur, but like, he told the SEC for all intents and purposes that they can fuck off, which is akin to like telling the IRS yesterday on tax day, I find you very interesting, but I plan on not participating in your process. Like, I just don't think that you can get away with that.
It kind of boggles the mind. I just don't understand it. Look, I don't short stocks very often because, I mean, what I've learned over the 20 years I've been doing this is that a stock can, in theory, trade at any price. And to the downside, I could always just buy more and average in and use price to my advantage. I mean, your only edge as a value investor is your ability to buy more cheaper. When you're shorting, it could go to any price and you just get run over. I don't short. Even when I was taking a shot at Tesla in the past, I was doing it with put spreads. I would never just actually take a directional risk.
So talk to me, because you are a long short manager, but if you're not shorting,
we're not short. I mean, we had the ability to short.
Okay.
Every once in a while.
So it's like I'm a brain athlete, and I just emphasize the brain part, not the athlete part, because working out is hard and talking is much easier.
Every once in a while, I do something stupid and sell a stock short, and then I usually pay the price. It's much harder to be a short seller. I mean, the great thing about being a long-sided investor is that you can make a few 100% when you're right, and if you make 300 or 400% on a win, it pays for all the mistakes you're going to make, and you are going to make mistakes at this. But if you catch an inflection in some stock that has been forgotten and beaten down, I mean, you really should be able to make a few 100%. And I mean, when you're shorting, the most you're going to make is 100%, and you're going to drive yourself nuts in the process. It's just a dumb way to make money. Yeah. And, I like to keep it really simple.
So speaking of simple, as you look at the market today, and I do think that this will be of a lot of interest to people, because I have been bearish and cynical and pessimistic, and I don't think I quite appreciated, like, and I had friends back in April, May, where like the S&P had come back up to 2,900. I'm like, dude, I don't know how you hold it, because Like there is no business, there's no fundamental earnings, no one knows what's going on. We're shut down, we're open, jobs are leaving the economy like crazy. And then we have the Fed with the money machine just pounding.
Brr.
Brrr. And so how do you look at the world and find things that look attractive and interesting, and how do you square your brain with some of this irrationality of the Nasdaq and Tesla versus the value stocks that you truly love that you want to buy?
Well, I think you have to start with the framework of Project Zimbabwe. And this is a phrase that I coined because I went to Zimbabwe in 2011. And, the electricity worked sometimes. The water didn't really work. There wasn't really food at the grocery stores. The whole country had broken down effectively through hyperinflation and mismanagement. Yet I went to the stock exchange that day, and I think the stock market tripled that day. And, it's what happens when you print too much money. It has to go somewhere, and it ends up going into equities, just like it goes into all other asset classes. And so with the Federal Reserve expanding their balance sheet rapidly, admittedly the last few weeks they've tapered, of course the stock market's going to go up. And I don't think they're going to be in long-term taper mode because I genuinely think that the U.S. has a structural deficit problem at this point, and politicians are refusing to address the deficits. So the only way you're going to fund it is by money printing. And I think the stock market's going to keep going up. I'm really hopeful we don't end up being Zimbabwe, but I have a feeling we'll be Zimbabwe light. And, knowing what I know, having visited lots of these screwed up sort of countries, I'm pretty sure that the stock market's going to keep going up, and you need to be as long as possible. And, there's only two positions that's long and very long, and shorting is suicidal. Even the frauds are going to go up. I mean, as we've all seen, sometimes the frauds go up faster.
Right.
You do not want to be short. There'll be shakeouts. You could be structurally short and try to grab 10% here, and that's really hard. And I don't like doing hard stuff. I like doing the really easy stuff, which is finding a trend, getting long, and ignoring the volatility. It's going to be really volatile because you have so many cross currents. You have, COVID. You have government incompetence. You have, political, geopolitical, money printing. All these things are going back and forth. And that's why the market's been very volatile lately. But the big trend is it's going higher, and you just got to be long the big trend. If you get the big picture right, you don't even have to get the small stuff right as much.
Right.
If you get the big picture wrong, it doesn't matter how right you are on the small stuff.
Right. Yeah, you get crushed. You just get freight trained. So you write a newsletter, and the website I believe is Adventures in Capitalism, correct?
Correct. Yeah.
And so talk to me about it. So the Project Zimbabwe is on there. I saw your newsletter this week, sort of talking about COVID and herd, and I think probably like me, when we weigh in on topics that like some of our readers don't necessarily like align their views, they're like, no, I really want you to talk about energy. I don't want you to talk about this. And it's like, well, I think it's really important. How do you view the fact that the Chinese trade deal was one of the biggest issues in early 2018 and 19, and then now that it's in the news and it seems to be falling apart, and what's going on in Hong Kong and China and India, geopolitical tensions are totally being ignored, and case count is rising and economies reclosing and everyone is ignoring it. And yet, as you said, the macro trend is don't worry, don't fight for the Fed. The Fed's going to print as much money as you need so the market goes up. How do you dissect that? Because at some point bubbles burst. And, or hyperinflation occurs, and hyperinflation has a whole bunch of other downsides, and we can talk about Zimbabwe in terms of that. How do you frame all that and write about it and synthesize it?
Well, I spent a lot of time reading. My background actually is a history major. Unlike a lot of guys in the stock market, I didn't go to business school. I became a history major. And then I left history school and realized that no one really needs historians. So I started trading stocks because that's where the money is. But I look at the whole world.
It's so simple. Money equals good. Yes, that's what I'm going to do.
I don't know. There'll eventually be a bull market in historians. These things all go in cycles. But right now the cycle says you go trade stocks. And what I've learned in 20 years of trading stocks is that these things all repeat. They're all cycles. And you can look at anything that's happening in the world today, and there will be an analog somewhere else, whether it's in U.S. history. We have pretty good financial history going back over 100 years, or it's some other country that's experienced what we're about to experience, or some other sector. But I mean, it all repeats. And what you have to do is look at the world today and say, what does this look like compared to something else that's happened in the past? and you learn about that thing, and it prepares you for what's going to happen. And that's why I use the Project Zimbabwe analogy, just because it seems like the direction we're going, unfortunately. We can look at pandemics in other countries. Usually the government over responds, they stimulate too much, and you kind of want to buy the pandemic and hold on. You can look at all sorts of things that have happened in the world. Now, I like to tell people that in the 20 years I've done this, I've seen so many cycles. A lot of these cycles are in their third iteration already in the same industries. You talk a lot about oil and gas. I mean, how many cycles is this for you?
97, 2000, 2005, 2008, 2004. This would be like almost cycle 6 my father was in 85 and 93 with the Gulf War, and so he was in energy, so I followed it. So arguably this is my 8th cycle.
So I'm sure you've learned a lot about how these cycles play out, and you have a good roadmap in your head of how it's going to play out going forward, right?
Yeah, and I do, and I think that a lot of people talk about this, and Art Berman, who we had on the show, talked about, like, everyone wants this time to be different, but as you said, in part, the fact that history exists and that people read about it and then make that as the theory that they're going to follow. So as you said, by the pandemic. So there's a whole bunch of people that studied the Spanish flu in 1918, and random people that know nothing about 1918 know that in 1920 things were phenomenal, and things went incredibly well from 1920 until 1929, at which point they didn't, at which point it took 4 years for the Fed to stimulate the economy, at which point it was almost too late and there was a W. And so it's interesting that you can, like, people who would have no reason to know what I just said, everyone in the world knows that, and that's the trade thesis. But yeah, I kind of think that this one's different, and maybe that's
well,
illogical.
The cycles are the same. But given the fact that you've seen multiple cycles, you can look at this cycle and say it's going to sort of look like this other one, but not like this one, and you can kind of narrow it down given your knowledge of the sector. Whereas, a generalist would look at it and not really know where to start. It would take them a lot longer to learn which cycle it's going to look like. And I think the mistake most generalists make is that they assume these things are linear, and they're not. And that's why they get hurt in the first place, which is why experts who have been in these industries always seem to make the money, and the generalists seem to always lose the money.
Right. So if you think about the comparison of this time frame, take away from the pandemic, but go to the bubble of 2000. And you and I talked about this on the phone, and Pets.com, totally independently, you and I were talking about Pets.com both on the same day, because what was happening in Tesla that day reminded me so much of what's happened in Pets.com and in every other stock that was happening in the year 2000, and all these day traders that were buying it and going crazy. And it worked out amazingly until the bubble burst. And so I'm curious how you would compare, having started your career in that and still trading stocks today, how you compare and contrast the cycle.
Well, this one's just a lot nuttier. I mean, we all talk about Pets.com.
So crazy.
I mean, we talk about Pets.com because, there's the sock puppet and he's doing this thing. But it was a $300 million company that raised, negligible amounts of money. These days, if you don't do your Series A at $300 million valuation, you kind of failed. It just seems ridiculous. Like, there's multiple companies that are tens of billions of dollars that have literally no path to profits. Some of them have in the millions of dollars, not even tens of millions in revenue. It just makes no sense that the order of magnitude of this bubble is bigger than anything we've ever seen before. And when it crashes, it's going to take down huge swaths of the economy, which really are fake.
So, which is then again interesting because, and so how as a listener and as a synthesizer of data, how do I on the one hand say, by the pandemic, the Fed will inflate, you have to be long the market, short of suicide. And on the other hand, we say, the bubble is here, valuations are insane. We work at a $47 billion valuation for a period of 30 days until people actually opened the financial statements and realized that leasing long-term real estate to short-term people with beards in a common space seems like the worst business model ever. But yet...
It wasn't even a tech business. WeWork took Regus, which is this like sad, boring office business where, lawyers and accountants go to escape their wives. And they made it sort of a little bit hipster. Regus isn't even that profitable of a business. And these guys couldn't make a profit at it, but all it did was basically have like free coffee at a Regus. I don't understand why it was in any way special, except for the fact that the people who owned the shares claimed it was special. And, the founder had this sort of like David Koresh thing to him.
But so how in your mind do you synthesize? So we know it's a bubble, but you can't fight the trend.
Oh, you don't go along the bubble. I mean, I've stayed out of all the Ponzi stocks. The entire Ponzi sector I've stayed out of. I focused on the companies that have actual cash flow and earnings, and I focused on the companies that are doing something that would make me want to own them. I just know that the Fed has my back, and these stocks probably don't go down. Right. But I want to be in real companies. I mean, I'm not going to short the Ponzi sector, but I want to be nowhere touching it. I don't want to own the supply chain. I don't want to be, anywhere near the Ponzi sector. That thing is going to detonate one of these days, and it's going to take down a lot of very sophisticated managers who are going to claim they didn't know any better. But I want nothing to do with that sector. So it means a lot of the tickers on the screen are not part of my investor universe, which is fine.
You're like, where is Honeywell? I haven't seen it trade on the is there a Honeywell, anyone? So how do you? Okay. So let's talk about the general sectors, and you don't need to give names, but as you build a thesis towards value, cash flow, interest, valuations, interest rates, the whole thing, where do you get excited about, and what makes you excited, and what level of work are you doing before taking a position in something?
So if you go back, 30, 40 years ago, you couldn't even get the SEC filings. You had to go to the Library of Congress or something to figure out what the companies were talking about. These days, it's all on a Bloomberg. I can do a scan and, scan for almost anything. Anything that is known as a fact is available. So if you want to look for the cheapest stocks on valuation, price to book, it's all known knowledge. There's supercomputers slicing and dicing this that's smarter than me. I would say most of this stuff is priced right, more or less. I don't feel like I have a competitive advantage just looking for a cheap stock. What I'm trying to do is basically look forward, because computers are really good at linear thinking, and the market's increasingly dominated by computers and ETFs and stuff. But they're really bad at taking data sets that don't go back long enough in time and analyzing the future. And so what I'm looking to do is say, what trends do I see in the market that the computers don't yet see? What do I see that's inflecting where the computer's looking at it and each quarter is incrementally worse, or maybe they're incrementally better, but there's no real growth. And I see something dramatically changing. Let me give you an example right now, and that's housing, single-family homes. In the early 2000s, we had a bubble in single-family homes. Low interest rates, people buying 15 homes to speculate, and it all blew up. And after it blew up, we never really had a recovery. I mean, home prices recovered, but the number of units we were constructing in America never went back to trend line. You could say trend line was fake, but in the end, the population of this country keeps growing, and we filled up the existing housing stock. The issue is that people really wanted to be in the cities. I mean, cities are fun. That's where the restaurants, the bars. I mean, that's where my friends are. No one wants to be in the suburbs. And then, millennials all pushed back having kids. So everyone is just fine with a one bedroom. And these trends, went on longer than a lot of people thought. And the housing companies did pretty terribly. But what's happened with COVID is that no one really wants to be in an apartment building and riding the elevator with a bunch of diseased people.
Unless they're really hot and want to make out, then the disease doesn't matter as much.
Okay, you're going a different direction than I was.
No, carry on. Sorry, I sidetracked you. But yeah, people want to get away from crowds.
You don't have to. It's not just that. You don't have to actually go to work anymore. Everyone's going to work from home. You want a bigger home because you're having kids, or you want a second bedroom to run your office out of. The cities right now are having riots, and that's not much fun to be around. And I mean, there's just all these competing factors. I mean, I'm from New York, like it's kind of a war zone right now there. It's all of a sudden gotten violent and dangerous. Like, who the hell wants to be around that? Plus, you have high property taxes, high housing prices, like all these things that make it unenjoyable. And so people go to the suburbs, and they're doing it fast. You wouldn't believe how many of my friends have called me up in the past 30 days and said, hey, I'm thinking of moving to Miami. Like, let's talk about how much you enjoy it, because I've been here 16 years. And so you're having a huge amount of flight from the large cities to second-tier cities, or to suburbs, or urban exurbs, or whatever they want to call it. And suddenly there's demand for housing. I mean, look at lumber. Lumber's gone from $250 to $500. That's telling you that there's huge demand for the supply chain. So I'm just looking at the companies that feed into that supply chain, whether it's companies that are distributing lumber products, making aluminum siding, windows, all the things that feed into the housing industry, which have been just terrible industries for over a decade, where suddenly their business is going to inflect. They're going to have some pricing power. They're going to have some margins again. They're going to have increases in demand. You can't build a financial model and say what's going to happen because your best, worst, middle case, the ranges of outcomes are so far that any financial model you build is worthless, which is why the computers can't model this. I could just look at this and say it's been a pretty bad run. It's going to be a lot better next year and probably even better the year after. And these things are priced like it's going to be terrible still. And, if there's even a little bit of recovery, these things are all 5 and 10 baggers. And I bought the whole supply chain to housing. Home builders are a pretty mediocre business, but, if you can pick up 100 basis points as a lumber distributor and, your net margin is 200 bips, you're going to make 50%, more. That's really good, especially if your volumes go up.
Right.
So that's kind of where that's how conceptually I'm thinking about stuff. My fund was really early in guns. The first day of the riots, we bought the Rugers and the Smith & Wessons and the Visto brands. They make bullets. These have all been monster trades for us. But it's all about identifying something that's a catalyst, identifying stocks that are undervalued, and then staying with it as long as the catalyst is viable. You look at the FBI NICS checks. They're off the charts. There's a whole new class of people that never owned a gun that are suddenly buying guns and buying multiple guns. This is going to be a trend that probably lasts for a while. You want to be long a branded consumer products company that trades at less than 10 times earnings that has seen growth. Of course you do.
Right.
This is kind of how we're looking. We're looking to identify a few of these trends each year, take very concentrated bets, and make a lot of money for our clients.
It's so interesting. So you talk about the 5 and 10 bagger potential and sort of where in the supply chain you're attacking versus the home builders. Home builders are sort of, the middle, but they're exposed to maybe land prices and speculation in an 18-month build and communities and
they get squeezed a lot because
right. That's what I was going to say.
As soon as home prices start going up, land prices start going up. You have Toll Brothers and Pulte and Hovnanian. They're all fighting to be in the same, rapidly growing cities. They're all bidding on the same plots of land. Farmer Joe that has 500 acres, he's going to hire a competent broker and they're going to get 10 bids. So, they're going to get squeezed on the cost side. They're going to get squeezed, here and there, labor. It's not a good place to be. But if you're distributing the lumber or you're making, flooring or roof trusses, all these things, there's money in that.
It's the housing thing is something I'd never thought about. It's a very interesting play on that. How do you go
Today,
ahead?
The National Association of Home Builders came out with their home builder optimism survey. I don't know.
Yeah.
You ask 100 home builders if they're having a good day.
Yeah, no, I saw that too, and I was like, I've never heard of that. That's so weird.
It was off the charts.
Yeah.
If you look at the chart historically, it's a really good number. These guys are gearing up to build a lot of homes, and you can see that because the price of lumber is going crazy. Because if you're going to build a home in September, you got to order your lumber now. It's got to be on site in August. So, you can just see it going through the supply chain.
Is there a limit on, for example, the lumber trade? So then you'd be watching for when lumber prices fall back, which supposedly would imply that the demand of new homes and building and those orders are going away. So you sort of start fading the trade at that point.
If you were trading, say, lumber futures, yes, you'd have to be really focused on that. If you're just looking at someone who's in the supply chain, it's not so much the price of lumber, even its volumes. They're distributing. They're just getting a markup by moving it from the lumber producer to the guy who needs it. It's volumes, it's pricing. There's lots of factors. Look, if lumber goes back to 250, these guys don't do so well. If lumber pulls back from mid 500s to mid 400s, that's just fine. Eventually the guys producing lumber are going to catch up and cut down some trees. There's a sudden demand, and then 90 days later is a catch-up. We're a very dynamic economy.
It's funny because we talk about oil and gas and we talk about climate change. We talk about biomass. Biomass, one of their key things is they're burning the trees and then replanting the trees. So somehow that's carbon neutral, which makes absolutely no sense to me. And we also don't hate home builders, even though they're cutting down massive amounts of trees to rebuild. Like it's amazing how we sort of pick and choose the themes that investors want to focus on or not. I'm curious your views on oil and gas. You've obviously been familiar with the sector, been around it for a long time. I've been pretty open that really since March 7th, my view is short the sector. Now there's lots of different ways to short the sector, and there's like physical shorts and emotional shorts. But it feels extraordinarily overvalued to me at this price, given the dynamics going on in the world. I'm curious your take on oil and gas stocks, how it affects the economy, etc. If you have any views.
Well, I mean, right now, I mostly have experience at losing money in oil and gas. Had I never heard of the sector, I'd be a lot wealthier. So I'm not sure if I'm the best guy to give you stock picks.
But I think that's great because most people have experienced that. So everyone's like, oh, I love Exxon. It's so great. It pays an 8% dividend. Most people who've owned Exxon, certainly since 2014, are way underperforming the S&P. And anyone who's owned oil and gas for the last 10 years, including the massive run up and the massive rundown, you literally could have been in any treasury and done better and not cause yourself nearly as much pain. And so there is this like coal-esque direction that equities have gone, and we've seen what happened since coal. So it is an important thing that when people say, I don't understand why investors aren't coming back into the sector, and you're like, because I wish I'd never heard of it, because I would be richer. So that is the reason.
I do a lot of cyclical investing, a lot of cycle investing. Every cycle in a commodity sector is the same, where people truly despise the sector, where capital finally gets cut off, which really hasn't happened to oil and gas until a few months ago, where capital just gets totally cut off, and there's wave upon wave of restructuring and bankruptcy and merger, and this is how these cycles eventually end. They're all the same. And you have to wait till this cycle makes its way through in the United States. You have a lot of guys that are still drilling wells that are not economic at today's $40 WTI. I don't know why you invest capital knowing that $1 goes in the ground and 75 cents comes out 3 years later. It makes no sense to me. But there's too many people playing with this playbook that you build it up and you sell it to some PE firm or you sell it to one of the consolidating majors. And I think that game is over. I would say that if you look at what's going to happen in U.S. energy, OPEC has a game plan. They intend to bleed out shale. They tried it in 2015, and they got cold feet because it was just too painful for them.
And Trump got elected in 2016 on the back of Republicans, which are primarily Texas, which needs the oil and gas industry. And so it is no coincidence that OPEC cut production for the first time in 2 years, 3 weeks after Donald Trump got elected in 2016.
Yeah. But I feel like what they were trying to do last time, all they ended up doing was lowering the service provider costs to a bunch of energy companies, and this made the energy companies more efficient. And they kind of realized that they weren't winning, and it's one of the reasons they sort of relented a little. And they just said, we got to wait a few years until we go through the tier one inventory. Here we are now, and they flooded the market. There's over 1 billion barrels floating around that no one wants, which is going to weigh down on energy prices for a very long time as we work through it, which gives them a lot more flexibility to keep pricing down. I don't think they want pricing at 20, because what that's going to do is bankrupt everyone, let them restructure their debt, and then go compete with OPEC with clean balance sheets. What they want to do is basically force everyone to slow bleed out. Drilling slowed down dramatically. Production is going to trail off over the rest of the year and next year. And what comes out of the ground is mostly going to be used to cover interest expense and a bit of debt amortization. Guys aren't going to drill. Guys are going to run down their production. They're going to run down their existing reserve bases and make no money in the process. They're just going to keep the lights on, which is actually better for OPEC than a restructuring of these debts that lets the guys compete with a new bankroll. And the way I see this is OPEC is going to outlast, the Permian. And the way I'd play this is to forget about choosing the bottom in oil and gas companies, though I do think that gas probably does okay just because byproduct trails off. I would instead say, if the U.S. goes from, call it 13, and we're at 8 in 2 years, and we're going to have to import 5 million more, you start looking around the world, where we're going to import it from. It's not going to be Canada because the tar sands, those aren't really economic at 40. I mean, they're probably not even economic at 50.
And Canada's really moved. The government has really, really moved, really left, and they're very,
Yes.
very, very Ansel. I mean, even the fact that the campaign in the U.S. to push that they're called the tar sands and not the oil sands. There's a lot of headwinds that are in the Canadian infrastructure. I totally agree with you.
Plus, a lot of their other production is shale, and it's just as uneconomic as our shale. You go to Mexico, like their internal decline. Venezuela is a mess. Maybe Brazil will stumble forward. West Africa is a mess. Libya doesn't have a government. The North Sea's internal decline. You start going around the map and start looking where, you just draw your circle wider out from, the U.S. and where they're going to get it from. We're going to get a lot of oil from the Middle East going forward. The Saudis are going to end up gaining market share. And for every million barrels we import, you're going to need 60 more very large crude carriers. And I think the long-term trend is that we're importing a lot more oil than we were last year. And it's going to be very, very bullish for tankers. And I own a lot of tanker stocks. I'm a bit ahead of the trend, maybe. I've been long them for over a year. This year, they're going to have the best earnings they've had since 2008. Bull markets are, you can look at commodities, and bull markets are indicated by year-over-year increases in price. And we've now had 5 consecutive quarters where quarter-over-quarter charter rates are up. Q3 charter rates will be down quarter-over-quarter, though they're up year-over-year. I think Q4 is going to be very strong. It's going to keep powering through, and these companies are earning very good returns on capital right now. It's been a 12-year bear market that's literally bankrupted everyone in the sector. There's almost no new vessels being ordered. The global fleet is the oldest it's been since 2002. The average age of a vessel is almost 10 years now. The order book's the smallest it's been in 20 years. I think you're going to hit a new happy equilibrium in the fleets, and we're already seeing that with charter rates up. But then, the real change is that we're going to start importing more at a time when, we're not producing more vessels. If anything, we're probably going to start scrapping vessels. So I think you're going to see a period of excess earnings. And for a guy like me that focuses on history and looks at, stocks that are inflecting, I want to be long during the period of excess earnings and out of the way when they're bleeding to death. And cyclical companies usually bleed to death most of the years.
Yeah, so it's interesting that you say that, because one of the things you talked about early on is you can be really wrong. So you need to pick things that you can get 5 or 10 baggers on, because if you're really wrong, in hindsight it always makes 20 cents. And so, like, the exact argument, if we take the tanker argument further, which is now the US is importing 5 million barrels more of crude from the Middle East, which, the green movement is very upset about this. They want renewables. They want electric cars. They want Teslas. They want to rebuild the power grid. They want the Green New Deal. Biden gets elected. And so the American consumer says, I don't want any more combustion engines because, and they go California. And then all of a sudden, 5 million barrels a day that would have otherwise been imported ends up not being imported because we invest in natural gas and build out the infrastructure and therefore have power.
You're looking forward 30 years or 50 years, and I'm trying to look forward 18 months.
Right.
You can have a roadmap, but there's going to be bumps along the way. I mean, eventually we're going to transition away from hydrocarbons, but I think there's a lot of impediments, both financial and just like physics related. Even if we were to go half EV today, the residual fleet on the road would take a long time to disappear. Plus, you have all the petrochemical industry and other things. It's going to be a slow, gradual transition. I think we're going to hit peak oil demand. It's probably going to take another 5 or 10 years. I mean, I've looked at a lot of models, and the funny thing about these models is they all get adjusted every 6 months based on the most recent data point.
Right.
But I just don't see it mattering. I think we're going to still need more oil going forward.
I totally agree. And so do you do a hedge? So again, I was projecting a lot further as sort of like, how does your trade not work out? And right. And so you say, like, is there a natural hedge, or when you're thinking about all the scenarios in the next 18 months that could prevent your success case, do you end up hedging on the other side, buying the whatever, or do you just, as you said, make concentrated bets that this is what's going to happen? Here's the reason it's going to happen. As long as it continues on that trend, we're going to do well. The second we really see a catalyst for change, we're going to exit the position no matter where we're at. Is that a fair characterization?
Yeah, I do the latter. Look, I mean, you don't need hedges if you buy cheaply. My tanker stocks, and I have a basket of them, they trade on average between 1/3 and 1/2 net asset value. They have very low financial leverage, which means that if the cycle doesn't inflect immediately, or there's a couple bad quarters, they're not going to be in danger of restructuring or a down round capital raise. Actually, a lot of these stocks are paying pretty hefty dividends right now. And so, first thing, the downside is the most important thing. The way to make money in this industry is not to make mistakes, and you protect your downside. But then you follow the thesis really closely. If the thesis is playing out, you stay with it. And as soon as the thesis changes even slightly, you got to reevaluate every minute. And I'm one of the first guys to get out. Thesis creep's very dangerous. But right now, my thesis is very big picture. There's a supply-demand imbalance in terms of tankers. These things only last about 20, 25 years. They get scrapped, and we're not producing new ones as rapidly as we need to. And global demand is going to increase quite dramatically, because between China importing a lot more oil and the U.S. needing to import oil, you're going to need more vessels to move this stuff around.
Yeah. So let's talk about you touched on passive investment in ETFs, and it's obviously been a trend. You're a money manager. You take clients' money and you figure out creative ways to make the best return. Whereas the ETF, the Jack Bogle Vanguard model is, buy an ETF, come back 30 years, it'll be fine. It's very passive. Some rumors that Tesla was being front run a little bit about being added to the S&P index. I'm curious if you think that passive investing has seen its heyday and that we're going to move back to more active in an environment like this, or how you bridge the gap between some of the stock picking active investment versus the passive investment that seems to be attracting so much capital.
Well, I think passive is going to keep going. I mean, trends in motion usually keep going just because. And anyone trying to fade that is probably too early. Eventually, it'll reach the point where the passives stop outperforming the actives, and then the money will shift back the other way. I mean, in the end, all the fund flows are driven by making money. Unfortunately, a lot of the active guys have underperformed for almost a decade. So, I mean, it makes sense why the passive guys are getting the capital flows. Unfortunately, passive is totally bastardized everything in my industry, because it's no longer looking at valuations and fundamentals and data points. It's more a question of which ETFs cross-own the stock, and as those ETFs get inflows, the stocks go up. And as the stock goes up, the weighting of the ETF goes up, and they has to buy more. It's this very recursive loop that just keeps feeding on itself indefinitely. And eventually it hits some crazy insanity level, and I don't think we're there yet. I think it's going to keep going, and that's unfortunate. One of the things that's I've found is that if you go below the 1 billion market cap threshold, there's a lot less passive, which means that you have much better signal to response in terms of what's happening in the news, which is where you want to be. You want to be able to make a fundamental view of something, and then if you're right, within a few months it responds. And you're not going to have that in the stocks that are tied up in passive, just because there's no one left to respond.
Right.
So my edge is smaller companies.
Okay, so you're going to less billion. Why do you think active managers? I mean, there's a lot of reasons, but in your view, why do you think active managers have underperformed the last 10 years versus passive? And I liked your description that money doesn't move to people because they like them. Money moves to people because they make them more money. And if passive is better returns, you're going to do that. If active is better returns, you're going to do that. But why do you think active, in your view, has underperformed? What has been the key mistake or mistakes that were being made by active managers over the last 5-10 years?
So everyone always fights the last war. And so the last war, the last terrible experience in my industry is the 2008 crash. And so a lot of my friends have ran delta neutral books. They've ran books that are, 120-80 or something, where they're 40 net long, where they're 200 gross. They've ran very balanced sort of books, which means that as the market's gone straight up, they've just underperformed because they have this massive short exposure. They've been reloading on puts forever. That went to put heaven. I think I think you just have this structural view that a lot of guys went out there in 2010, 11, 12, 13. They went to rich guys that had seen huge losses of the net worth, and they said, look, if there's another crash, we're going to protect you from that. We're going to own these puts. And, we're going to underperform on the way up, but you're not going to lose half your net worth. And that was a really good selling point. Unfortunately, the market's gone straight up, and all these guys are underperforming now. And these rich guys are saying, well, I don't need these puts. I can just go buy the S&P and not pay this guy 2 and 20. I mean, why do I even need this guy around? You're going to need a crash where these guys lose half their money. I mean, the most recent crash, it bounced back too fast. No one really felt any pain. There'll be another crash. That's how stock markets work. And you'll have one that doesn't bounce back as fast. And I think, everything's a cycle in finance. And this is a cycle that's gone on for 20 odd years, and it'll go back the other direction. We had a similar cycle like this in the late 20s where money went into basically, they're called investment trusts. The investment trusts just bought the same 10 stocks, the RCAs of the world. Much like, Amazon, Tesla, those
Apple, Microsoft,
the Fabulous Five. I mean, RCA, General Motors, US Steel, that was like the Fab Five of 1928. And then once the trusts had cornered it, if there's no sellers, marginal amounts of incremental buying send it higher. And the trusts start buying each other and, piling leverage on. And that's why, when the market crashed, it was so sudden in 1929 because you had multiple rounds of deleveraging. As these trusts that were levered, 50% got margin calls and margin calls and margin calls. But it was very similar to what's happening now because you had the same sort of passive thing. And that cycle only was a 5-year cycle, but these cycles repeat themselves over and over again. And this one will unwind. And when it unwinds, that Fab Five, you're never going to want to be anywhere near it because those stocks will go down every day 1%, every day for 2 years.
That is my recollection of 2000 and 2001 after
the
Cisco went down every day for 2 years, 1%, every day, just kept leaking lower.
It's truly unbelievable that when things finally correct, you see oil and gas. And so back to, your comment on, I wish I'd never seen oil and gas stocks because I would never have lost some money. They have literally been leaking. There's been a couple up, but generally they've been leaking 1% a day for 6 years. If you could go back and meet yourself as a younger, your 2003 self, and from everything that you've learned that really would have changed the outcome, whether it was on an investing thesis or a personal thesis or books you read, what would you tell your 2003 self that you think would be really impactful?
Never invest in mining.
That is a good one.
My oil and gas record is a lot better than my mining record. Put it that way.
What's your least favorite mining story of a thesis that just did not work?
There was a mining stock that had an operation in Peru. See, the thing with oil and gas is that at least you have revenue. So that revenue can kind of float you around from time to time. But if you are a junior mining stock with no operations, you need to raise capital every 6 months just to pay salaries, drill holes, do the engineering study. There's just always money going out the door and no money coming in, which means you're just selling hopes and dreams. And so we went to this deposit in Peru, up some godforsaken hill, and I also got hard food poisoning. And it looked right, we took some chip samples, we sent them to the lab. But they weren't faking the numbers. It all looked good. We put my hedge fund put money in at the time. I put one of my really good friends into senior management at the company. Another good friend I put as the chairman. And a few months later, we learned that it turned out the company didn't actually own the assets. The CEO's brother owned the assets, and they had forged some documents with the auditors. And the Peruvian courts had fake documents, and it was one of these things you could only dream up. The company had spent millions of dollars drilling holes on the brothers' mining license, and eventually we threatened the CEO with legal action in Canada, and we fixed the problem and got the licenses transferred back to the company's name. But it just shows you how you can spend weeks and months looking at something and you never really know what you see. I mean, we looked at the titles. They I don't know what a Peruvian mining title looks like, but I sent it to a guy that knows. He wrote back, yes, these are valid. He checked with his buddy at the mining ministry. It turns out they had all been forged.
I mean, it's incredible. Is it too cynical to openly question how often that happens in every business? I mean, without again drawing attention to Tesla, but you're not the only person that says it's a fraud. And even the CEO is saying, like, I think our stock is dramatically overvalued. I've never heard a CEO say that. Do you think that there's a lot more?
I think that's just drugs.
Yeah, it could be. Do you think there's a lot more systemic fraud in the market than you'd like to believe?
There is a lot of systemic fraud, but it pockets in funny places. I would say 80% of companies that are domiciled in China are fake. Not just like sort of fake, like Enron, which they did something with energy, they just didn't do as much as they said they were doing. As in, like, completely fake. You have like Alibaba is your Enron. The numbers are all made up, but they do something. Whereas, you have a bunch of these other ones that truly don't even exist. They literally have no employees or revenue. It's just a scheme. If the SEC was actually doing their job, none of these companies would ever have listed in the United States. I think a lot of these foreign companies just have more fraud. It's just U.S. investors are less capable of sniffing out the fraud. What's amazing to me is that there are guys who have just phenomenal track records. Your Muddy Waters and your Citrons and these guys that, they bat 90%. Like it's as good as you can get. They'll miss one or two, and they can just go out there with documents and data and say this thing is just a fraud. They can do a 20, 30-page article on it, and you can read the article and be like, wow, you've literally spent thousands of hours researching it. And then you have institutional investors, your Fidelities of the world, that still own these things and own these things in massive size. And it just boggles the mind that these people who are supposed to be fiduciaries are so lazy that they refuse to read the research, or even worse, they just ignore the research after they've read it because the stock's going up, so you have to own it. It's like this Luckin Coffee. I went to a conference in January. It's one of the bigger frauds. It was in theory a coffee chain in China, and I was at a conference where they presented, and I listened to the presentation. I just remember with one of my analysts, and we're listening to this presentation in a room with a couple hundred people. And we're saying this makes no sense. Like, your growth plan is to install, vending machines that produce coffee. Like, we had this in the 1970s. Like, how is this? Like, nothing that the CEO said. It was a typical company with, 7 Chinese guys, but the token white guy who does the presentation. No one speaks English, and we were there and we heard this whole thing out. And it's like, okay, I'm going to start it for one-on-one. I want to talk to this guy. Like, this doesn't make any sense. And we're sitting there at the table. It's myself, the analyst, like 4 Chinese guys, and this token white guy. And we're going through some of the numbers. And this is just from the presentation 30 minutes earlier. And they're changing the numbers on us. And I'm going, no. This is the numbers that were in your presentation. Like, this is your slide deck. Like, turn to page whatever, like, encircle it. Like, I was taking notes. And they're like, no. Well, it says that, but it really means this. I'm like, did your general counsel look at your slide deck? Like, how is this even possible? And I walked out and I said, this thing is the biggest fraud. And it was like a $10 billion company. Like, this thing is one of the biggest frauds I've ever seen. Like, I don't know how people could own this. And then, a few weeks, maybe 3 months later, they halted the stock and it opened at $2. It was like a $40 stock. It was a total fraud. Like, nothing exists. And it just boggles the mind that when you look at who the relatively intelligent investors are that own the shares, and many of them owned, tens of millions, hundreds of millions of dollars of stock that, like, look, if I owned $1 million of stock, I'd go visit the company. I'd go to China and, snoop around and figure it out. I'd meet with management and learn that, like, the numbers change as you talk to them. Like, this is like basic stuff. This isn't even like my fake Peruvian mine. Like, we actually went to the asset. And I don't know how these people get these things wrong.
Wow. That is quite a story, but unfortunately, you'd certainly hear about it more and more every day. Do you think the SEC can do any? Like, I know this sounds like maybe a naive question, but is the SEC even incented to go do any of this stuff, or at this point do they just They're just like, yeah, what's like the TSA guy? What's that? A candle looking bowling ball. It's going hair dryer with a scope. Yeah, just keep it going, people. Keep it going.
Well, I think the problem is that the SEC, had they 5-10 years ago been more diligent, they would have stopped some of these frauds when they were in the tens of millions or hundreds of millions, and it'd be a non-problem. Instead, they let some of these like Tesla grow up to be a $300 billion fraud. If they take it down and it opens at zero, there's 40,000 jobs at risk and millions of shareholders that own it either directly or through ETFs. It's so systemically disruptive. If they were to actually do their job now, they really can't.
Right.
I mean, they could start by forcing better due diligence of these IPOs. At least you end up with no new problems. But as soon as a company, lies about the numbers and it grows, and I've spoken with people that run quantitative strategies, and quantitative strategies are usually based on a very simple formulaic approach where you look at revenue growth, earnings growth, and analyst guidance upgrades. Price targets, and analysts just raising their estimates, and you kind of build a prism, and it's basically just tracking companies that are growing fast, but it's having a computer look at this because you're looking at the second derivative rate of change to get out of the trade. And so these guys know that if you can have 100 companies in your portfolio and 5 turn out to be frauds, it doesn't really matter because you're going to have one every 6 months. Maybe it goes to zero, so it's just 100 bips drag on your overall portfolio that's outperforming by 1,000 bips. They accept the fact they're going to have some fraud, and the risk now is if you actually went out there and took out all 10 frauds in the same week, these guys underperform, and it's really problematic. And it's one of the dangers. It's very much like the Federal Reserve by overinflating. If they had stopped, if Greenspan had just let long-term capital failed, a lot of the problems we have now 20 years later wouldn't exist. But because they bailed out every large hedge fund throughout all of history, hedge funds say, why do I even need to, look at the downside? PE firms say, let's just put 4 more turns of debt on it and it fits our return threshold. And no one ever worries what happens if there's a down quarter. And now the problems are structurally too big that you can't escape them. And I feel like the SEC is in a similar spot. I mean, they'll take out some little tiny $20 million company every once in a while, and they'll bust a little Ponzi scheme. But I mean, I don't even know if they could take down a Madoff these days because 50 billion hits the economy. I think very much that 2008 wasn't so much Lehman failing, though there was like cascading, bankruptcies and stuff because they failed. I think it was really Madoff failing, where everyone said, bring me in, every family office said, bring me in my CIO. Here's your mandate. I want you to liquidate the 30 hedge funds we're in. And the CIO goes, but this guy's doing well. This guy we've been with for 15 years. And the rich guy just goes, liquidate them all and then fire yourself. Like, we want to be out of this industry. So you had this massive liquidation that all happened in the 90 days after Madoff, because if you don't liquidate a hedge fund that's getting liquidated, everyone else has to liquidate because you put your redemption request in, there's like 45 days notice and this, and you don't want to be the last guy at the door, you want to be the first guy. So everyone just went and liquidated, and I think that's what actually caused the crash, not so much Lehman. And I think if you did it today and there was another Madoff and the SEC actually investigated it, I mean, it would take everything down. I don't know of another Madoff of that scale, but I'm sure it's out there.
Well, if for listeners who want to stay on top of this stuff, Adventures in Capitalism is a very interesting kind of weekly note. Whenever it comes to your mind, I was going to say
writing.
Whenever
it's a free publication. I write about whatever I find interesting. It's stock picks, it's geopolitics, it's trends I'm following. It's just whatever. It's basically after I have a couple beers with a friend and we discuss something, I say, that'd be interesting. Let me write about that because, this guy told me something that was interesting. Someone else might find it interesting.
Well, and that's where the original motto of my hot take of the day came from, which was write drunk and edit sober. Because that's what all the best brainstorming is done. So, Harris, I really appreciate you joining and sort of sharing a view, a window into the microfinance world, some of the trends you're thinking, some of the things that are on your mind. I really look forward to seeing the ongoing writings, and I'm going to have you back on the show. Certainly the first Bernie Madoff that comes up, but the first time Tesla has a major step up, we're going to have a deep dive into that. So thanks so much for joining us. Until next time, be safe, be good, have a great day, and bye for now.